Congrats, everyone. You're almost at the happy hour. I hope you guys have had a great conference. For those of you that don't know me, my name is Anand. I lead business development and partnerships for Kronos Research. Kronos is a quantitative research and trading firm specializing in digital assets. We started out as a proprietary trading firm, and now we offer a spectrum of services, including market making, asset management, liquidity provisioning, and advisory. Now, I have the pleasure of moderating the beta problem. Are crypto hedge funds just levered indexes? To discuss this, we've put together a great panel of capital allocators with very different strategies, so it should be a pretty interesting conversation. We'll start off, let's just go down the line. Can you just introduce yourself, your firm, and let's go from there.
Sure. Hey, everyone. Thanks for joining us. I'm Matt Shapiro. I'm a partner at Multicoin Capital. Multicoin is a thesis-driven investment firm focused exclusively on crypto. Today, we manage several billion on behalf of institutional capital. We do so on both the public and the private side of the market. On the public side, we have an open-ended hedge fund that is directional, fundamental-driven with a concentrated strategy. And then on the venture side, we have traditional venture funds. We're currently investing out of our third vintage there.
Hey, everybody. I'm Colin Jones. I run Outerlands Capital, which is a liquid digital asset manager specializing in alt tokens. We are very data-driven, kind of pioneering factor investing or smart beta, whatever you want to call it, in the digital asset landscape. And prior to this, I was a finance professor at the University of Notre Dame, minding my own business when I got infected by crypto in 2013 when a student simply asked, "Have you ever heard of Bitcoin?" And then I read the white paper, went down the rabbit hole, and departed academia in 2021 when my interest in academia was declining inversely to the price of crypto assets, and jumped ship and have not looked back, but excited to be here.
Hi, everyone. I'm Mitch Ulman. I'm the Chief Operating Officer of Numeus. Everything we do is crypto, everything we do is in the liquid markets, and everything we do is active management. From a range of fully systematic 24/7 trading to a more fundamental bottom-up, token picking, I guess to some degree, bit of what you guys do. And we also have a liquid multi-manager where we are identifying and allocating to a broad set of third-party, best-in-class hedge fund managers, absolute return focused in nature. So when you talk about beta, that's zero. That product is zero by design and actual. So I think, as Veer was mentioning, and next, we have, I think, a lot of good strategies represented across this panel.
Max Williams, co-founder of Runa Digital Assets. We're a crypto investment firm solely focused on liquid strategies. Fundamental, discretionary, token selection type strategy. Been around for just over 4 years now.
All right, excellent. Guys, can we just take a few minutes to dissect the title of this? What is beta in crypto? Is it Bitcoin? Is it the first top 10, top 20 tokens by market weight? Let's make it free discussion. Mitch, you want to kick it off?
Yeah, I can. I mean, look, I think the reality is there's still a lot to be defined. If you look at some of the market cap weighted products out there, yeah, Bitcoin's 75%. So yes, beta is mostly Bitcoin. You add Ethereum to it and it's 90%. I think over time you'll start to see indices that are more broadly representative, beyond just those top two. And quite frankly, I think one dynamic that is inverse to how we saw the traditional hedge fund world and active management play out, or traditional markets play out, is whereas before, sort of traditional strategies started out as mostly active managers, and over time has moved to majority of assets passive. That's going to flip. We started essentially fully passive, at least on the liquid side in the crypto world, and over time we will see more added to active, and as that gets added, I think there's going to rightly be more scrutiny placed on managers and their ability to actually generate alpha. So
I'll jump in. I think it's a really interesting question, and I'll push back on the title of this panel because beta is not a problem, right? Like, people use this like it's a derogatory thing, and you only want the alpha. The beta in crypto is phenomenal. Like, it's volatile, but it's #1 performing asset class in like 13 of the last 15 years. Who the hell doesn't want beta? It's like an order of magnitude more exciting than any other asset class. I think if you look at the returns, right? And so if you think about the origins of beta, and I'll nerd out on finance professor Jones here, it was the idea of what risk can I not diversify away through just holding multiple assets, and you get to like the core systematic risk of just owning risk, and that was very macroeconomic driven, and it was trying to isolate how do I think about risk exposed to the macroeconomic economy that I can't ever get rid of. And then we sort of started proxying for that with the S&P 500 and equities, because to the extent they reflect the fundamentals of the economy, that kind of works. And then you started using beta in measuring in like performance fees for active managers. And so then it got very specific to asset classes, and people started talking about asset class specific betas. And so if you think about crypto in that sense, then like Bitcoin is the beta, right? But if you think about it as like, well, what's my exposure to the larger macroeconomic risk environment? I don't think that works. It kind of breaks down. And I think when you think about where the most exciting risk-adjusted returns are going to come from, it's not going to be called beta. It's not going to be called Bitcoin. It's going to be the other stuff. Mm-hmm. But like beta is not a problem. It's you want that. You want to do it smartly, and you don't want cowboys out there YOLOing on meme coins and stuff. There's a lot of we'll get into it, but there's a lot of cool things you can do to really simplify and improve your investment universe.
Yeah, I agree with that. I think for quite some time, a lot of investors have just looked at crypto and said, okay, Bitcoin is beta. It's easy to get exposure to. It's easy to understand. It's a fantastic asset. It's the biggest asset, and a lot of investors have frankly done quite well just owning Bitcoin. But now, and you're starting to see it with like the ETF flows and with the passage of the Genius Act this year, all of a sudden it's very clear that if you believe in tokenization or payments or stable coins, and if you think that's coming on chain, which it very much is, all of that innovation by definition happens outside of Bitcoin. And so all of a sudden you're kind of intellectually and financially short if you're just owning Bitcoin. So how do you start getting access and exposure to all of those concepts? Well, it's definitely not in Bitcoin. How do you get it? And you're starting to see people go in through ETH. Solana is a good example. And so all of a sudden you're moving down the risk curve into other assets that do different things within crypto. And there's not a great way to capture that, candidly. Like Bitcoin is great, then you want to move into something that's more like an index. You end up with like the Bitwise 10. Bitwise 10 is a fantastic product, but it's market cap weighted. And so it's 90% Bitcoin and ETH. If you add an XRP, it's like 95% three assets. And I can tell you that's not representative of our portfolio almost at all. Like we see value almost everywhere else than there. And so as that, I think the challenge with indexing and like beta broadly is it's structurally flawed from a crypto perspective because the underlying assumption is that the market is efficient. Or you want to index assets that are going to grow and compound and are have been risk averse and de-risked in all these different ways. In crypto, everything is just so much more fluid, and there's so much more risk and uncertainty. Go back and look at the CoinMarketCap top 20 from 4 years ago or 8 years ago. If you go back 8 years, I mean, there's assets and tickers on there that you didn't even know they existed. Right? And I think that space will continue to move that way. And so it's very hard to have beta and indexing when the market itself is inefficient. And I think that's why I think active management is sort of better in this time period until it becomes solidified, where value is flowing, how, cash flows exist, how to value these assets. And once there's more institutionalization there, then I think indexing and beta becomes a lot easier to solve.
Yeah, can I just say, I guess one part just for, conversation's sake to push back is, to your point, if it's changing so much, that means things are going down and other things are going up. It's a very fluid thing. That would it would kind of validate why Bitcoin, ETH, and Sol should be not 90%, because that means those are the right assets. If those are still the top three assets, so that would kind of make the argument you are indexing the right assets over time. So I think. I think an index is supposed to be largely representative of the asset class as a whole, and I think those assets capture most of the market cap of the asset. It's like a representative thing, not a value thing, not like, I think the index is undervalued here. I think it's mostly just to be representative.
I'm going to add one thing to what Max said. If you think about it, so the market cap is captured, right, by those top three or by the Bitwise 10, but the activity is not, right? And like we put something up recently this week that's like 90% of fees are in non-Bitcoin, non-ETH assets. 90%. 20% of the market cap is in those assets. So like that gap is going to close. And if you only own Bitcoin and ETH, you're missing out on 90% of the on-chain activity, and that's only going one direction, as Matt said. Like you need to own more stuff, and I think it's so easy to look historically at what's happened in the last 5 years, last 10 years, and we can look at the correlations and the price movements and the volatility, but that's going to break down. And we've seen periods in crypto where the correlation across like the top 100 assets is similar to stocks, so like 0.4, and that's not always the case. The correlations move around, but there's just a lot of opportunity to build more interesting portfolios than just indexing to Bitcoin and ETH.
All right, so let's double click on that. Let's talk about portfolio construction. Colin, why don't we start with you? Look, you definitely have a systematic approach. Do you want to talk, maybe not get too academic about it, but do you want to just double click on this?
I'll explain why I look so bad, right? So I used to be beautiful, but now I look like shit because we wanted to do a data-driven approach using on-chain data. So picture transactions, users, fees, the growth of those metrics, the wallets, turnover, consistency, blah, blah, blah. And this is, in our mind, the way to measure the on-chain economy, and we wanted to do this across a broad swath of assets. And I undertook this endeavor not knowing how terrible the on-chain data was, and this was 4 years ago. So we've done a lot, incurred a lot of brain damage building out our data lake. Been pictured like 125 projects, 24 plus variables across all of these projects, and trying to get apples to apples. And if anybody's tried to do this, it's a lot. It's pretty easy on the top 5, top 10 assets. It's really difficult on the smaller assets to get high quality, high integrity data. So we built that data lake, and then lo and behold, there's some low-hanging fruit from like a factor analysis standpoint. So we're looking at market cap to fees, market cap to users, market caps to transactions, and the velocity of all those numbers. And so like it gets pretty interesting really quickly. And so when we're building, we do a bunch of stuff, but in our sort of flagship fund, we look at 125 to 150 assets. We define that universe by liquidity, and then we overlay our data model on where we think the highest risk-adjusted returns are going to come from, and that sort of filters out, and we overlay a fundamental layer, so we want to have eyeballs on everything and not just trust the data because the data series are so short. So it's quantamental is what people would call it, and then we end up with anywhere between 25 and 40 assets any given quarter, and then we just buy them really efficiently, and it's like pretty freaking boring sounding, but it's actually I think it creates much more compelling portfolios than any sort of market cap or equal weighted index approach to the alternative tokens would do.
All right, let's look at a different approach. Max, tell us about your sector diversification strategy, and how do you guys typically tend to manage that correlation risk with, what long bias, I should say, crypto investors face, which is that high correlation to Bitcoin?
Yeah, I mean, I think we kind of apply like a sector framework to the space, 5 different sectors, kind of cryptocurrency, true like currency, competing assets like Bitcoin. We kind of think they've won that market. Then we have smart contract platforms, Ethereum, Solana, DeFi, utilities, kind of like infrastructure tokens, and then like consumer applications. So generally, we're looking across those, all those spaces for opportunities, and I think we would prefer to have some diversification, but it's not a mandate. We're not, we don't mandate hold ourselves to have exposure to those sectors. I mean, just not much activity. The reality is in the consumer sector really right now. I think most of the activity is and the value we're finding is in DeFi, smart contract platforms, and Bitcoin. So we don't kind of mandate ourselves to that, and I think crypto is kind of narrowing, at least right now, its product market fit is in DeFi. So we've kind of narrowed our focus to that. But we think about diversification maybe instead of across sectors, also across ecosystems. So looking at Solana, Ethereum, Base, and monitoring each of those. And we're certainly overweight at certain times, but also looking, trying to look at where there's value and rotate into that at different times. So wanting to have some exposure to each of them as just some of them are appreciated much and look to take profits there as things kind of get fully valued and rotate into more value-oriented sectors, ecosystems.
Mitch, you listed all the stuff that you guys do, market making, liquid tokens. How do you typically allocate between all of your different strategies?
Yeah, so look, we try to be very disciplined and explicit and transparent about what we do. We're not mixing a bunch of stuff together. There's nothing wrong with that. Just from our perspective, if you want exposure, right, to the growth of blockchain and who are going to be some of the winners in that space, you should be investing in a long-only strategy. And so our product we launched before the ETFs came out in early 24, and so we put together a portfolio that, of course, you should have a sizable exposure to Bitcoin at all times. Of course, you should have a sizable exposure to Ethereum at all times. We don't think we can trade that well. We're just going to give you core exposure and adjust if those get a little too high or a little too low. Where you should be judging us and our success is our ability to pick the 15 to 20 other altcoin tokens where we think there is really alpha to be generated. We'll get into pricing in a minute, but you price that product accordingly. You don't charge 2 and 20 for a product like that. I hope I didn't offend anybody, but you don't charge 2 and 20 for a product like that. Subsequent to that, some people said, I don't need to pay you for the Bitcoin and Ethereum exposure because I can go buy it for 5 or 6 basis points. And you're like, you're right, you don't. So just buy the altcoin piece. And oh, by the way, we stake the assets, and anyway, the management fee nets down to close to zero once all those staking rewards are passed through to investors. So that's one approach. Our multi-manager is a lot more involved, but let me talk about that very briefly. There's nothing long biased about it. That is all about allocating to best-in-class managers, whether they do it through SMAs with us or through funds. The world of crypto is way more transparent and data is way more accessible than in traditional markets. And so the amount of transparency we have, we get a lot of comfort around that, and trying to put together a diversified portfolio of stat arb type managers, market makers, high frequency traders, DeFi, funding, you name it, something that blends into a nice diversified portfolio, zero correlation to Bitcoin, zero realized correlation to S&P. It belongs in like a traditional absolute return hedge fund bucket. And so very different. And so can it be confusing to investors sometimes? Yes, but you just have to be deliberate as to these are different ways you can access alpha in these markets.
And yeah, we will get into the fee question after this, but Matt, Multicoin is known for concentrated conviction bets, but they're also known to be active versus more passive, right? So can you talk about how being active helps drive alpha?
Yeah, absolutely. I mean, I think a lot of these assets are young and they offer venture skew, but they also offer venture risk. As a result of that, I don't think there's a lot of value in diversification. I think there's a high correlation amongst assets in the space, and you could say that payments and stablecoins are going to be great, and you could say I want to own 12, I can own all the smart contract platforms out there, but the truth is the vast majority of them are going to zero. And so I don't think diversification actually protects you in crypto. I think you want to be concentrated. And so you really need to develop a thesis around what are these assets, how do they grow, how do they scale, what are their network effects, how do they create value, how do they capture value, and then really build conviction in that thesis where you have an edge over the market to build a concentrated position. Then the question is, okay, you have a concentrated position, like how do you best utilize that, right? How can you actually help create positive externalities and create the flywheel effect to actually help those assets in the portfolio? It's not that much different from like a traditional venture fund, right? You are trying to help the team where you can. You make introductions. You do.
Can you give a
lots of
quick
different
concrete
things.
example? Just 'cause I do want to get into this next one. Can you give a quick concrete example on that?
Yeah. So I'll give one example. We recently launched what I believe is the largest Solana digital asset treasury company. It's called Forward Industries. We partner with Galaxy and with Jump on it. And it's really interesting and unique from like a portfolio construction perspective because we already own SOL in our hedge fund, right? We've already taken the risk. We've already underwritten it. We do that work. It's a concentrated position. We like it. All of a sudden, by investing in a digital asset treasury company Forward and by being actively involved in it, we dip into the sponsor economics, right, as part of this digital asset treasury company and the pipe. All of those sponsor economics go to the fund. I don't know how other teams do it. All of it for us, the GP doesn't see it, Multicoin doesn't get it, I don't get it, Kyle doesn't get it, nobody gets it. It all goes into the fund. So from a fund perspective, it's really interesting because we're taking the reason that Ford shares in theory would go up is because the price of Solana is going up. So we're taking this exposure that we already had, we shift it from SOL to Ford shares, And we're taking kind of the same risk, basically, that we were taking with Solana. But if Sol performs as we think it will and it goes up, our sponsor warrants will kick in on that deal. And so it's leveraged Sol in the portfolio where our investment in Ford should actually outperform just passively owning Sol in that sort of circumstance. And so that's like a unique angle that we can do to help create alpha within the portfolio.
Perfect. All right, guys, we have about a minute each, so we're just going to go quick on this one. Quick role-playing game. Imagine you're running a multi-manager model. What questions are you asking your prospects to distinguish alpha from beta? What metrics are you digging into other than correlation to assess that? And then for fees, how are you structuring the free arrangement? Is it like Bitcoin plus X percent or some other hurdle? Mitch, since we alluded to this earlier, you want to kick it off?
Yeah, and I know we're tight on time. So what I'd say there is, first and foremost, give us your data, because numbers don't lie. Look, the beautiful thing about crypto markets is you have 365 days of trading every year. Traditional markets, you have 252, plus or minus 2. In the venture capital world, you have 4. When you get your quarterly. So nothing wrong with that, right? But when you're in the world of active management, the numbers don't lie. And so we get, daily performance numbers from every single manager we're considering allocating to. We run all, the standard metrics you would expect. Understanding volatility, understanding exposures, you name it, understanding biases that managers may not even realize they exist in the portfolio, and then ultimately how does that portfolio may look great by its own, but when we add it to our own portfolio from a correlation standpoint, it's not sharp accretive, or maybe the risk return is attractive, not stellar, but when you add it in, the low correlation, significantly boosts it. I was at 2 Sigma for 12 years. This is, Quant 101. Others who, have been in this space for a long time. And so for us, you start with that, and if it passes that test, you go and talk to the manager, and you see if what they're doing you think can persist over time, or if they might be a one-trick pony. It's no secret that in the quant space, a lot of the early stuff that's in the crypto world has existed in the TradFi world for a long time. Don't fix what ain't broken. But over time, people are going to have to evolve more into that, beyond that, and we'll kind of see how that plays out.
Yeah, I think we don't run a multi-manager fund, but I'll just speak to the directional crypto exposure and knowing a lot of the funds out there is that, we're very interested in the reason that we launched our firm and run the processes the way that we do is something that's really going to be repeatable and scalable, explainable. In 2021, I think it's somewhere near 90% of altcoins beat Bitcoin by a lot. And so just anybody who was investing in altcoins in 2021 did phenomenally well. A lot of them took huge performance fees. Back to your point about the hurdle rate, I think we're one of the few funds in the industry that has a Bitcoin hurdle rate. So if we don't outperform Bitcoin, there's no performance fee, and then it's just a management fee only, pretty inexpensive product. And I think that's fair, right?
You actually might be the first one I heard about that.
I know people have said it's heroic, and yeah, it's fucking stupid. Yeah.
we don't take a managed fee unless we charge a lower management fee. No, that's one thing. This is traditional hedge funds. Again, places I've been at before. Sure, there's nothing. There are still several good funds out there that people would kill to pay 2 and 24, right? Because they deserve it. But where you have the confidence in your own alpha, and somebody's like, look, I'd rather pay a lower management fee and pay you to perform. That's where managers put their money where their mouth is. And so, like you said, hurdle rate, you get paid more because you deserve to get paid for it. So, I think increasingly we'll see more. More allocators pushing on that as more money flows into the space.
Sorry, so we're running out of time. I just want to give Max a quick.
Yeah, I guess real quick. The other thing I think active managers can do, relative to an index or a benchmark, is manage downside. So risk management on the downside. I think that's an important factor. I think people, cutting off the left tail of returns that crypto offers, like it has fat tails, and I think cutting off the left tail is just as important as capturing that right tail. So I think that's just another component of what active managers can do.
I just want to add one thing because it stuck with me. I won't call the person out, but it's one of the best things I've heard in terms of when you talk about beta, when you talk about volatility. Somebody at a recent conference said in passing, just like there's good cholesterol and bad cholesterol, maybe you're in the audience, there's good volatility and there's bad volatility. And without getting too quantitative, when you look at managers' Sortino ratios, you'll see that having exposure to managers that have volatility, Sortino ratios can look a lot more attractive than your standard Sharpe ratio, which you don't see as much in traditional markets. We don't need to get into why, but having exposure to, in some ways, the upside can be greater than the downside.
All right. I think we're out of time. We covered a lot. I want to thank the panel. I want to thank you, and I want to thank the TIE for putting this together.